Welcome to TheoTrade. This is Don Kaufman. February 25th, 2022. We are an hour after the cash close here on a Friday afternoon. Absolutely smoking rally hits the market, of course, on Thursday and Friday. We're going to try to answer the question in this weekend's update. Will this snapback market rally hold? All right, let's get to work and do a brief kind of index and sector update right now. Obviously, we're going to start inside of the S&P 500, work our way into tech, financials, maybe an energy sector. I mean, listen, that is what is driving markets presently. We're also going to talk in detail about a hedge that really caused, in large part, this entire kind of snapback rally, and I'll describe precisely what that hedge was and how it transpires to turn into, if you will, a rip your face off rally. So to give you an update on the week, you have to start with in sheer respect to the fact that, yes, the markets have actually finished the week higher. Now, obviously, we entered into a lot of conditions throughout the course of this shortened holiday week in what we could definitely construe as heavily oversold territory. Now, I'm not one for the charts. So whether I'm looking at the S&Ps, listen, I see a tremendous amount of red on the screen. I am more than aware if you look at the year-to-date percentage. And again, I'm much more of a quantitative trader, right? To me, like year-to-date percentages, that's more, significant. And again, coming into this week, we're already down basically 10% on a year-to-date basis, specifically to the spider. So again, there's a lot of red on the screen. I think we could definitely constitute that the marketplace was oversold. That's nothing compared, of course, to the QQQ. The Qs, of course, hit what we would term bear market territory this week as well. If you're unaware of what bear market territory is all about, it's basically a 20% decline from some of the recent highs. The interesting irony here is I'm not even going off the recent highs. I'm just going on a year to date on a percentage basis. And at one point on Thursday, we did actually touch down to bear market territory in the QQQ. Listen, I'm not telling you anything, okay, that you don't already know. There's so much, though, that has transpired this week. We do have to provide a little brief update and give you a little background before I dig very deeply into this. I think probably the most critical thing that everyone is discussing, and even the conspiracy theorists are out on this one, is what we would term this kind of absolutely violent snap back rally. To put it on a 1 day, 1 minute, I don't think necessarily does it justice. I'm going to move to a 30-day, 1 hour. First of all, we had discussed last week in the update significant levels. Some of those levels are right around, for example, the 4211. And we had discussed that if markets, specifically the S&P futures, had crossed under 4211, that things were going to get absolutely downright violent. And violent we saw. I mean, we crossed under the 4211, volatility exploded. But this caused a very fast, very violent move back to the upside, which I'll describe here in just a moment, and that is the hedge that really shifted the markets. And it's going to be a little convoluted, but you're going to be able to handle this. So the markets, again, they finished the week ultimately higher. One of the things, though, that is at issue right now, and it's why I kind of wanted to give you this update, we are still in that wild volatility channel. That volatility channel really kicked off all the way back, here in, again, late kind of January. We're trading right back in that same volatility channel presently. And by trading in these volatility channels, what we're starting to do at this point is accumulate more and more and more open interest. Now, one thing that I want to stress in this weekend's update, option markets are moving, the S&Ps, plain and simple. It is absolutely a cart that is leading that horse around. So when people start to look like price action in the marketplace, listen, please, I've heard it all before. All you got to do is cruise over to the SPX, okay, and you start to look specifically into some of the option statistics. And there's not a huge amount about like open interest and so forth, but here's the bottom line. You want to know what's really driving the market? The SPX, first of all, is an options only product. Okay, this thing traded 2.2 million contracts here. You know, 2.2 million contracts of a $4,384 product. This is literally like 10x beyond what? Almost anything else on the screen. I mean, when I say 10x, it's like 10 times the notional value. In some cases, you can't even compare like SPX. How do you compare it to Apple, which is a $164 product, but 2.2 million contracts? You may not know this, but yesterday we traded a total, okay, of 53 million contracts in the entire marketplace. When you start to put this number together, you're like, whatever, man, the SPX is only 2.2 million of that. Okay. Yeah, but it's also between 10 and 20 times the size in terms of notional value. Then you add in a little spiders in there. And I've done this before. Okay. But I can't stress it enough. I've done this before. And here's the big one. You ready for it? Yeah. Look at that. The spiders traded. That's right. 9.2 million. So you get the spiders that have done 9.2 million. Okay, and that's the SPY. You get something that's 10x the size of it, which traded about 2.2 million. Then you got to actually cruise over, of course, to another product like VIX, because VIX is, S&P. It did another 400,000 contracts. You start to realize that the entire marketplace is being shifted by trading going on to the SPX, trading going on to the spiders, VIX. I mean, you could actually constitute a lot of that activity right into Apple. Okay, you're like, Apple only did 1.5 million. You look a little Tesla in here. They're all major components of the S&P 500. And again, okay, what do you get? You get the cart leading the horse. And it's one of the things that I'm going to remind you of here in just a moment, because again, it's the option market that is really gripping hold and moving the S&Ps. So when I start to talk about like volatility channels, people, listen to me very carefully here. I don't care what you might think, okay, about a particular chart. Doesn't matter. We're accumulating massive amounts of open interest right in this, okay, neighborhood. And in doing so is going to drive more volatility right into this neighborhood here. All right, so you keep that in mind, because if there's a huge amount of accumulated open interest, what do? We'll start to hedge in and around that particular zone. So the market gets this just flying bid back under it, just to give you a quick, kind of feel for what markets look like. Well, we take a look at the spiders. We apply auto expected move. The spiders did finish the week higher, but mildly so. Take a look at the QQQ. The QQQ finished the week higher. Again, mildly so. We look at the IWM, the Russell, finished the week, again, higher, mildly so. The financials. This is important. Financials actually did finish the week, okay, ever so slightly lower, okay, critically important, because we're going to talk about the financials here in just a few minutes. Last but definitely not least, the energy sector finished the week mildly higher after touching the upper edge of the expected move, a lower edge of the expected move, the lower edge of the expected move, and almost the upper edge of the expected move. You want volatility? You got volatility, people. All right. So again, we finished the week higher. Now let's start to break down again more of the quantitative side of things. First of all, everybody wants to talk about volatility in the marketplace. So here it is, the VIX. Okay, the VIX is still in the 27 handle. All right, right off the bat, you got to realize, all right, volatility structure. That volatility structure, when I start talking about volatility structure, let's just look at the baseline here in the VIX. It's a 27.5 VIX. Do you feel warm and fuzzy? No, you don't, nor should you feel warm and fuzzy with that kind of a VIX. Now, that is just on the surface. When I say you don't feel warm and fuzzy, basically what I mean, nobody's going to feel happy with that kind of a VIX. The next thing you need to look at is the volatility structure itself. And this is what we term contango and backwardation. So taking a look at the volatility, okay, and the volatility futures, 18-day volatility futures, take a look at them. Then I want you to go out a little further in time, and you'll see, okay, you've got 27, basically 35, all right, in the MAR, which is March, okay. Then you jump out to APE, all right, so the April is trading at about 27. we are definitely still in backwardation. It's not a massive backwardation, but we're in a backwardation. So once again, does that leave us warm and fuzzy? No. When you go further out in time, the 54-day, which is the April's versus May's, yeah, they're still in backwardation. Even the May versus June. So we are absolutely still, okay, in a backwardation over there. I just wanted to leave you with that impression because the volatility structure right now, again, you can't feel all warm and fuzzy about markets until we actually drop out of that backwardation, move back to contango, until VIX, for example. And again, VIX is just doesn't do it for me. I mean, the VIX, we got to get back down to 24, maybe 22 to kind of wave off the all clear. The next thing I want to actually focus on for a moment is bonds. So the bonds are in the midst of a roll, okay? And the bonds, if you look at the week, all right, and again, I'm going to adjust for contract changes in the bonds because they're a little funky right now because of the roll that has taken place. But the bonds still finished the week, what? Higher. And you know what? If you're not comfortable looking at bonds, we can look at the TLT, all right? So the TLT, and again, caught between the 10-year, the TLT itself is caught between the 10-year, you know, and the 30-year. But if you look at TLT, it's a little bit of a different picture here. I'll bring up auto expected moves. The bonds finished the week ever so slightly lower, meaning that interest rates there actually increased a little bit. Take a look at the 10-year. 10-year finished the week ever so slightly lower. All right. Again, it doesn't sound the all clear in this particular case. You know, one thing I will tell you, I would have anticipated in a week like this, okay, that more traders would have rushed into the bond market. And again, this one, it really does leave me kind of in limbo. And it leaves me in limbo simply because it's not what I expected. And now I'm not comfortable. And I'll tell you exactly why I'm not comfortable with bonds. Now I really do. I fear bonds turning around and selling back off. If bonds start to sell back off, are we going to go back into like a tirade inside of the Nasdaq? So everywhere I'm looking right now thus far, yes, we finished the week higher on the marketplace. Okay. Yeah, volatility structure, though, isn't all that warm and fuzzy. Bonds leave me in complete limbo. So then I move right on to like the dollar. Okay. The dollar. Everybody turned to the dollar when the proverbial fear hit the fan, as expected. Okay. The bonds, you know, everybody rushed into bonds initially, sold those, but they also rushed heavily into the dollar. The dollar, though, on the week, okay, substantially higher. Not only does that, it doesn't leave us in limbo, that just simply screams the risk is still prevalent. So from looking at the volatility structure, which still says risk is prevalent, bonds leaves us in limbo, dollar ultimately says, okay, that again, we are still in some serious and tumultuous volatility. Okay. Where does that really leave us? Like how did this massive rally turn about and occur? And what I'm actually going to talk to you about here, albeit briefly, is a hedge that played out that really shifted the markets, okay? And to give you a better feel for this, because again, I've heard everything today from, it's a conspiracy theory. All right, here's the bottom line with the hedge that shifted the markets. And I'm going to do this looking at the S&Ps, okay? But in this case, I'm actually going to bring up the spiders. It's a little bit of a cleaner chart. And I'm going to go ahead and I'm going to close up the left side bar. The trade that has been transpiring recently has been very, very heavy. And I want to make this very clear, okay? There have been heavy put, okay, buyers. There have been heavy put buyers. We've known this. There's lots of articles coming about. You can see the volume. But those heavy put buyers have been in the SPX. They've also been in the SPY, hence why we're actually doing this in the spider. When did all this put buying start to transpire? Pretty much, people, since the volatility's been on, the put buyers have been there. Okay, specifically what went on, and in very, very simple terms, these put buyers here turned around in a big reactionary low, okay, and started to do what? They started to sell puts. Now, blank the screen for a second here, okay? I want you to think about the act of turning around to sell puts. Now, they're already long those puts. They're turning around now and selling puts, okay, that they own. selling the puts. Now, why were they buying the puts in the first place? Were they taking a directional bias? No, they were probably hedging. All right. So as the market was actually going down, they're turning around and again, they're buying puts, right, to actually hedge downside risk. And at some point, you got to relinquish that hedge. You have to turn around and, of course, sell those puts. So imagine, okay, that the entire trading community turns around and starts to sell puts. Huge amount of it. We're not talking about market making firms. We're talking about, hedge funds. We're talking about money managers. They sell puts. Now, the market making side of the business, here's the market making side of the business. They'll turn around and have to buy those puts. Why? Because they have to make a fair and two-sided markets. Now, when you buy puts, what does it do? Buy puts implies nothing more, okay, than what? Negative delta. How do you offset negative delta? What are the market-making firms going to do? These market-making firms are going to go out there, okay, and they're going to have to buy positive delta. Where are they going to find positive delta? Okay, S&P futures. They're going to go out there and they're going to buy those S&P futures to hedge that off, to actually balance out their equation, to neutralize all of their delta. So for the most part, you really want to know what actually caused this rip your face off rally, okay, it's trading. All right, that were selling puts. They were selling mass amounts of puts. And it actually started pretty much from the cash open. Minute the bell went off on Thursday morning, we started seeing huge amounts of puts being sold. And again, they're not opening transactions. They're actually, in most cases, closing transactions. Once again, okay, what transpired over here was actually offloading hedges. The offloading of hedges causes this huge spike up in the marketplace. You saw more of it even today. I mean, why do you think that? I mean, look at this, 9.2 million, okay, inside of the spiders. That is like an unforgiving breakneck pace. Even in the Qs. I mean, the Qs did almost 3 million contracts today. Insane numbers. All right. Spiders, 9 million. SPX, 2 million. All right. Even look at the IWM, the little engine that could. Nobody ever trades this thing. Almost did 800,000 contracts. All of this was offloading, okay, these monstrosity type hedges. Now, there is an issue, okay, at play. And one of the issues that you have to think about, by the way, if you're kind of curious, the number of puts that traded in here, yeah, almost 6 million puts traded inside of the spiders. All right. So we rally back up. My assessment on this one, strictly my opinion, okay, in very large part, the market's actually priced in most of the Ukrainian conflict, was priced into markets. That's why, markets ultimately finished the week a little higher, because the worst case didn't necessarily come to fruition. It's one of the reasons you can also argue that even oil finished the week. If actually you want to look at oil, we can look at the commodity markets here. Oil finished the week ever so slightly mildly higher with the rest of the marketplace. Nevertheless, again, the assessment, the market's actually priced in most of the Eastern European conflict. Now, let's get more serious. Pricing pressure is coming moving forward. We've actually had Fed speak throughout the course of this week. Everybody missed it though. Okay, there was actually a Fed voter this week that turned around and said, yeah, we need to be moving Fed fund futures 100 basis points by mid-year, meaning that by June, okay, they want at least, 4 quarter-point hikes. Well, that would basically mean we'd have to kick off with a 50 basis point hike, but they want Fed fund futures coming up. There's been more inflationary data. That's actually something you're going to hear about a tremendous amount, of course, this next week. Why? Well, first of all, take a look at the calendar. There's plenty of data coming out, obviously. There's always data coming out over here. But everything from like GDP to employment situation is going to be out. But there are going to be data drops throughout the course of the week. There's also, okay, ECB minutes coming out. Okay, you cannot just, brush these off. Factory orders. There is Fed speak the entire week, right? So everybody from even Jerome Powell is going to be speaking throughout the course of the week. So get your helmet on, because again, something that was missed this week is, well, the whole inflationary system, just don't worry about it. They brush it off. It's coming back. The other aspect that you really need to think about moving forward, and I say it's pricing pressure moving forward. To answer the question, will the snapback rally hold? Well, you may see some more rally maybe on Monday. Okay, but one thing I'm going to tell you right now, hedges have largely been removed. Look at the volume in the S&Ps and tell me otherwise is impossible, because the hedges have largely been removed. It's going to leave the entire market, okay, vulnerable to more volatility. Much more specifically, better watch the financials. The financials, to me, that is going to be the most vulnerable sector. One of the reasons why, okay, it's only down 1% year-to-date basis. It's the massive, massive outperformer, okay? Got to watch this stuff. All we know at this point, okay, hedges transpired. Hedges actually caused the snapback rally. Okay, the assessment again is that the markets were actually pricing in heavier risk, okay, than eventually did transpire. Lastly on that, again, pricing pressure is coming back in because everybody's going to get all kinds of hawkish again. Inflation, not only isn't inflation going away, again, I've said this before, I'm going to say it again. Inflation's going to explode, people. It is going to explode. Okay, for the simple reality is it's a last gasp, if you will, to buy, especially high-end items, everything from houses to cars. Okay, you know, if you actually look at some of the durable goods today, those were through the roof. Why? Low interest rates. It's the last time you're going to get low interest rates for quite some time. And that, people, unto itself is actually going to drive some of the inflation. Last but definitely not least, in this update, of course, we cover the expected move. In the midst of the snapback rally, people tend to forget what's really important, and that is the market actually shifted itself right back into the range. Well, that was anticipated, and that range is known as expected move. This previous week of trade, we had about $121 expected move, meaning we're supposed to go up $121, down $121. I mean, come on, we saw every ounce of it. And you know, the irony is if you actually looked at this shortened holiday week on Wednesday, we literally closed on the edge of the expected move, broke through it, rallied back up, ended the week higher. That $121 expected move, what are we going to see this next week? Yet not too far from it. Okay, this next week, the expected move is equivalent to plus or minus, okay, $126. So it's slightly higher, but there's a difference. This is a 5-day trading week. The previous week was actually 4 days, come into a 5-day trading week. Okay, do not look at this as like, all right, so they crushed down volatility. One thing that really resonates with me, $126 move, people. Okay, the S&Ps today alone moved $96 higher. Okay, from where I sit, I would anticipate you're going to get every ounce of $126 and then some. Volatility is very much far from over. Take a look. Everything from correlation coefficients, they're through the roof. You look at volatility, it hasn't settled. Dollars hasn't settled. Okay, the bonds leave us in limbo. Everywhere you look, okay, again, the markets may have priced in the risk, but there's a lot more risk coming. Will the snapback market rally hold? Absolutely not. It's going to be met with heavy volatility. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.